Coming to you from the Tar Heel State, this is the Carolina Commercial Real Estate Connection, bringing you industry insights and hot takes from Carolina real estate experts, helping you begin, grow, and scale your commercial real estate portfolio. And now your hosts, Tony Johnson and Cameron Pearson.
Welcome to another episode of Carolina Commercial Real Estate Connection. Today we are joined by Yonah Weiss. Yonah Weiss hosts his own podcast called Weiss Advice. He's a current real estate investor and cost segregation specialist. Yonah, thank you so much for joining us today. Thank you.
It's a pleasure to be here, Tony and Cameron. Thanks for hosting.
Awesome.
Absolutely.
And Yonah, we just talked to you a moment ago. Where are you located right now?
So I'm living the life, living the remote life in Jerusalem, Israel right now. So the holy city.
That's amazing.
Yeah.
A beautiful place. The one place that I hope to go at some point in my life. You're a lucky man to be able to live there. Now, where were you born?
So born in Boston, Massachusetts, but I grew up in California. Most of my childhood and young adult life was in California.
So give us the rundown. What are you doing in Jerusalem?
I came to
and what are you doing there?
I first came to visit here. I took a junior year abroad study program in Jerusalem, actually the Hebrew University in Jerusalem, and I just fell in love with the country. I don't know. It's hard to describe. There's just such a feeling here. It's a very spiritual place. It's an amazing community. And I'm, a religious Jewish person. So I felt like at home in a lot of ways, and, went back to California, finished my degree, and then was like, I got to check it back out. So, quickly made it back here, and spent many years here. I met my wife here. She's actually from New York, but we met both in Jerusalem and decided to stay.
What a great story. So
yeah.
How many years have you been there now living?
So I've been living here now about 22 years.
Oh, wow. Okay.
Yeah, but only really got started in the real estate world in the US about 8 years ago.
Can you give us a little background of your journey? What got you involved? How did it start?
Sure. I was a teacher for many years. So, just settling here, and was a teacher studying and teaching. I started a nonprofit organization. So my involvement on the day-to-day was in that world, and really my passion, and loved it. But at the same time was very little pay, living a very, kind of frugal life, and ended up having, a lot of student debt and otherwise with a growing family, just became difficult to continue that path. I knew I needed to make a change. And just reached out to some friends at a certain point, saying, hey, I'm looking for opportunities. What would you suggest? And real estate kept coming up in conversation. And then I met a friend of mine really kind of serendipitously in the parking lot one day. And he was I didn't even know what he did really. I knew he was somewhat in real estate. We never really talked business. I was never really excited about or involved with business or finance or anything like that growing up or throughout my young adult life. And I was just like, hey, David, what do you do? I'm looking for an opportunity. Maybe you can. I knew he was in business. He was in real estate. I said, what do you suggest? He said, well, you know what? You can come work with me. I was like, okay, what do you do? So he's like, I'm a mortgage broker. And the truth is, he was much, much more than that. But he had been working as a mortgage broker for several years and was remotely also, and was very successful. And he had just left a company and was going off and starting something on his own. He also owned properties and was a property manager and had done a lot of different things as well. And so I ended up just basically apprenticing him, sat with him in his office for about 8-9 months, almost every day. And we just had a great time together, learned a ton about commercial real estate, from knowing nothing, absolutely nothing. Like, what is a cap rate? What is an LTV? Like, what do these things even mean? Until becoming, thank God, very successful in what we were doing. And, little by little, I, was networking and learning a lot about the industry and open to opportunities, and met the company that I'm currently working with, Madison SPECS, Madison Commercial Real Estate Services. And kind of the rest is history.
Very cool. So the mortgage broker side brought you in, but he obviously did a lot more than that. So that's pretty interesting.
Yeah, he was a lender on his own, and then he ended up opening his own, lending business later. Did fix and flips together. Like I said, he owned multifamily properties and did all the asset management remotely, and so it was really really cool to kind of see how that worked. But yeah, I mean the beginning was just cold calling banks and owners and trying to just get involved in originating loans. So it was fun.
Well, and that learning curve you're talking about going from 0 to 60, that's pretty impressive.
Yeah, it was great.
Yeah, that's a quick turnaround. So David, your friend who was a mortgage broker, started and he had some multifamily property. So he basically brought you in under his wing. You worked with him for 8 to 9 months and got involved in how much real estate did you pick up in that 8 or 9 initial months?
So we didn't pick up anything at that point. What we did, we're just working in the industry and getting involved and learning about commercial real estate. We ended up doing some single family fix and flips together. After that, I ended up working and getting my residential broker's license and did some deals. But during that time, there was nothing at all.
Okay. So your journey was getting going there. You're starting to learn, doing the single family. And then what transitioned you to commercial? What was your first commercial project?
Yeah. So like I said, I was doing some deals here in Israel, actually. I got involved that way through another guy I met kind of randomly. And we had a lot of fun together doing brokerage and sourcing deals, finding some land deals, some commercial properties, met with some of the biggest commercial developers here and was doing, quite a few deals, but I really didn't like the Israeli real estate. I guess it's very cultural differences and it's very difficult for, for us for someone who's kind of an outsider, not an outsider, but really doesn't have the connections to really be successful. And so I, again, was open for opportunities and met this company, Madison, who's based out of New Jersey and New York. And they were doing, cost segregation, and they're a big title company. And I just, was interested in a different opportunity and ended up taking it. And so that's kind of how my real foray transition into more of the commercial real estate space was through this cost segregation company, and then through the networking done through that.
Awesome. So now, in cost segregation is your specialty. So can you kind of give us a brief overview for those who don't know and those trying to learn what cost segregation is and how it relates to real estate transactions?
Sure. So it's a tax strategy. And anytime anyone buys a property, whether it's residential or commercial, as long as it's not your primary residence, you're able to take a tax deduction called depreciation. And depreciation, it isn't what it sounds like, right? It sounds like your property is going down in value, but it's not. It's actually just a borrowed term for this tax deduction. Allows you to literally write off the entire value of your property minus the land value over a long period of time. So it's over a 27.5-year period for residential properties, 39 years for commercial properties. Cost segregation is essentially an advanced form of depreciation that allows you to take some of those deductions upfront in the first year or the first several years of ownership. So it's a cash flow mechanism that essentially pulls from this pool of potential deductions and allows you to take a lot upfront.
So, and this becomes extremely important for investors. How can you break that down? And what's the big advantages? So what's the big benefits that they gain from implementing cost segregation?
Yeah, I mean, the biggest advantage is, like I said, the cash flow. It's using time value of money. It's using, being able to get these huge tax write-offs in the earlier years of ownership to essentially, in many cases, pay little to no income tax on, on your properties or any income for that matter, if you're a real estate professional, which allows you to scale. I mean, think about being income tax specifically is the biggest expense that any individual or business has, throughout the year, every year and throughout their lifetime. And this is a strategy to essentially pay little to no income tax and use any of that money to reinvest and scale and compound. So that's the real, main benefit why people use this is, that tax advantage that allows people to grow much faster.
So it's going to allow for deals that may not have made sense to all of a sudden start looking better on paper. Is
That's
that what
true.
I'm hearing? Okay.
That is true. People take that. I always recommend that, a deal should make sense on paper besides for the tax benefits involved. But the tax benefits can be, good icing on the cake. But you're absolutely right. There are certainly deals that people are doing specifically because the tax benefits make more sense.
Fantastic. So let's say we're getting into a cost segregation deal. What are the things I should know? Are there certain guidelines or tax regulations that I should understand before trying to purchase a property and pursue cost segregation with that property?
Well, there's always a great insight to reach out to someone like myself. Most cost segregation companies will provide an upfront free estimate or analysis for any property. So you can see a breakdown and you can see the difference between taking what's called straight line depreciation, just as little deduction every year, spread out over that long period of time, 27 or 39 years, versus using the cost segregation or bonus depreciation method, which allows you to, take much larger deductions during the earlier years, the first 5 years generally. So you can see that. I mean, that's really the main thing you need to know is just, figure out, hey, does this make sense for my situation? It's not going to be for everyone, but it is certainly going to be, make a lot of sense for someone who intends to, continue investing over the foreseeable future.
So continuing investing is a great idea on it. What about the idea with cost segregation, and correct me if I'm wrong, we want to make sure I'm holding this property. I'm not doing a cost segregation on a property that I plan on selling in 7 years, right?
Well, not necessarily. I mean, typically I like to think, if you're holding property for at least, 2 years, that's usually the best time to get a cost segregation study done. Again, if your intention is to continue buying more properties over the years, it makes even more sense if it's even less than that sometimes. But it doesn't have to be, over a 7-year period. And the main concern is something called depreciation recapture tax, which is anytime that you sell a property, you are going to be subject to not just the capital gain tax, which everyone understands that you're paying a tax or you're subject to a tax on the amount between, the difference between the purchase price and the sale price. You're going to be taxed on that capital gain. Similarly, depreciation recapture is you are taxed on the amount of depreciation taken as a form of capital gain, which means if you take more accelerated depreciation upfront, which is what cost segregation does, you're going to have more of a tax being subject to on the sale, which means if you're holding a property for a shorter period of time, the time value of money of using those deductions is going to be less. So that's why, like I said, 2 years is usually the minimum hold period I like to recommend, but you can hold properties again, since it's going to be used from one property to the next, meaning you can use the deductions from one property to offset the income or the gains from the sale of another property, which means as long as you're continuing to buy, you can continue to kind of keep this cycle going and even defer those taxes further out.
Yeah, to your point, that's the scale you were mentioning. So that's
Exactly.
how you can scale easily. That makes a lot of sense.
Yeah, that does make a lot of sense. So is there someone getting into investing that might be newer? So if we're looking at, let's say, $750,000 commercial purchase, is that the amount of money that someone should consider cost segregation? Is that too low? What is a starting point, or what's a good number to start looking at cost segregation?
Any price point, I'd say over $200,000 is already going to be worthwhile looking into cost segregation. It may not be as beneficial from one person to the next, but you have to realize there's obviously a fee involved with getting a cost segregation done, which is why we always run that upfront estimate. So you can see what's the difference between, and the fee is never going to be contingent on the tax savings. It's just going to be a flat fee based on the size and type of property. But nevertheless, that can be a few $1,000s. When If you're, dealing with $200,000 purchase price, you may be getting, taking 20 or 30% of those deductions of the purchase price upfront in the first year, the first few years, which is, going to be 10x the returns in terms of your tax benefit, even after tax benefit of that investment of the, few $1,000s, whatever that is. So obviously the higher the purchase price, the more benefit there is, because you're talking about $1 million property. Again, you take 20, 30% of that, you're dealing with $200,000-$300,000 of tax write-offs. That's going to be much more beneficial, even though the fee is going to be essentially the same in terms of the cost of getting one of these things done.
Okay, so I just want to make sure. So can we run through an example deal for anybody listening, and you kind of run it down so them and even me can completely understand. So let's just keep it round numbers. So let's say I'm buying $1 million property. So I come to you, I say I'm buying $1 million, 12,000 square foot retail strip center, a multi-unit center. So what are you wanting to know from me? And let's kind of just walk through an initial analysis, and then you kind of give me a rough idea of what all you would ask and what we would need to know and what we could expect that we could get out of cost segregation.
Well, the first thing we're going to do is look at details of the property, like the purchase price. You mentioned, let's say $1 million, the square footage, how much land improvements there are. So let's take a step back and understand how cost segregation actually works, because we didn't really touch on that, but I think you'll understand a lot better in terms of how the tax benefits are going to work when we understand what goes into the cost segregation study. The first thing we're going to do is, like I said, subtract or, allocate a certain amount towards land. And that's going to affect the total amount that we can depreciate. Typically, it's around 15, 20%. It depends on the location. It depends a lot on what the county assessor. So, places like California, where it's notorious like 50, 60%, 70% land value sometimes, which is crazy. Whereas, other places where, it can be out in the middle of nowhere where the land value may be like 1 or 2%. And so you have to understand what that land value is so you can subtract that. Let's just keep it round numbers, $1 million property, let's say 15%. Our basis, the amount that we can fully depreciate, is going to be $850,000. Okay, taking off $150 for land. That $850, like I said, for a retail strip center is going to be straight line depreciation over a 39-year period, which means that would get us about a $20,000 deduction every single year. Just round numbers here. It's probably a little more than that, but $20,000 is a great deduction, right? And that's regular depreciation. Every accountant knows this. Everyone is going to take that deduction. Cost segregation comes in and segregates the cost of that property and breaks it down into its components. And we're going to show that the structure and the structural components of the property is the only thing that depreciates over a 39-year period. So that's going to include stuff like the roof, the walls, the doors, windows, foundation. So all the structural components, whereas any interior components that are non-structural, like, flooring or furniture, equipment, appliances, anything, countertops, shelving space, anything like that is all going to be, and many other things as well, is going to be depreciated on a 5-year schedule. So we're going to take the value of that, and a retail strip center can often be, about 20% of the value is going to go into that 5-year depreciation category, meaning we can now take, 20%, let's say, of $850,000, right? That's, what is that, about $170,000 that we can now take as accelerated depreciation deductions instead of that $20,000 deduction every year. The other main thing we're going to look at is what's called land improvements. So the land doesn't depreciate, but what's on top of the land does. And very often in a retail strip center, you're going to have parking lot, you're going to have pavement, concrete, landscaping, signage, fencing, storm water drain system, anything like that. All of that depreciates over a 15-year schedule. So again, that's going to be accelerated, and we're going to take those depreciation deductions up front. What that's going to look like now is going to be, sometimes $200,000 or $250,000 or so that we're going to be taking as accelerated depreciation in the first 5 years or so. And with bonus depreciation, another rule we can talk about, you can actually take that as a lump sum in the first year. And so that's a huge, huge value, comparing apples to apples. Instead of a $20,000 deduction, you may be getting a, $100,000 or $200,000 tax deduction in the first year that can be used not only to offset the income from the property, but also any other source of income, or gains from the sale of real estate. So this is why it's such a huge value, because again, that's just one property, $1 million property. Think about if you have a $10 million property or you have several properties, you can be literally, just taking huge tax losses, which again, if you have a high income tax, or income tax bracket, you can be saving, a ton of money.
That's really, that opportunity not only is for the investor. Let's say you have passive investors joining in on a deal. Do they benefit from that general partner putting together a deal and doing cost segregation?
Yeah, passive investors can benefit, but it's important to realize that not all people are created equal when it comes to tax deductions. And so I always like to kind of paraphrase one of my favorite books, George Orwell's Animal Farm, where it says, all animals are created equal, but some are more equal than others, right? And so similarly with the tax payment, all real, tax players are equal, but some are more equal, which means real estate professionals, someone who's full-time, can use those deductions against active income or against any source of income. Whereas if you're a passive investor and not a real estate professional, you're going to be limited just to use those deductions to offset any passive income, which means real estate income. So yes, there is a benefit, a huge benefit for passive investors, because essentially they'll be able to use these deductions to pay, little to no income tax on any income coming in from any of their investment properties. But they'll be limited. They won't be able to use it to offset their W-2, for example. If they're like a high income earner, they're looking to get, which is very common misconception. People think, oh, I'm, making a lot of money in my job, I'll invest in real estate and then pay no taxes. Unfortunately, it doesn't work like that.
Yeah, that's something I wouldn't have known. So that's really interesting that, because a lot of people think that way. They're like, I got to shelter this income. So that's great. Thank you.
Yeah, that's critical to know. Yeah, and once you're designating, when you're doing, as you can designate yourself, just to go back, once you're designated as a real estate professional, when you're doing your taxes, that's the only way that you can fully take it off of your W-2 income, right? So, but still, as you just pointed out, any passive investor, it's off of their gains from the passive investment, and still there, it has a great benefit to them, especially if they're investing in multiple deals and using that as an investment vehicle for themselves. Still gives a big advantage, I would think, comparatively speaking, to investing in stocks, right?
It's night and day, because you don't have the tax advantages of investing in stocks that you do with real estate at all.
Yeah. So, and you get with real estate, you get the tangible asset. So, there are a big advantages looking at when someone from a passive perspective to investing in real estate and then investing in the stock market, even if you look at them comparatively speaking on returns, let's say 7 to 8 to 10% a year, and then you get the tax benefit with the passive real estate investing. So that's definitely a great way to think about it.
Is there a certain percentage of your income that needs to be to have you noted as a real estate?
There's not a percentage of income. Yeah, it's looked at on, the IRS looks at what's called a real estate professional based on your job and what you do, how you spend your time. So specifically, you have to spend more than 50% of your time in the real estate trader business, which means anyone who's a broker or real estate agent is automatically qualified as a real estate professional, as long as you're not spending, more time in another profession, simultaneously, which, can occur. But the other important thing is you need to be what's called materially participating in that trader business, meaning you have to have some rental property. So I always tell real estate brokers, you're already a real estate professional, but in order to get the benefits of this tax designation, you have to own real estate as well, because without owning the real estate, you're not going to get any of this depreciation to be able to offset your income. But yeah, it's specifically around the hours spent, and it's only, in fact, one of a couple. Meaning, if your spouse is a real estate professional, you can benefit from this as well.
Very cool.
That's great. Now, Yonah, if someone is working, I know you're out of New Jersey. Now, your company, Madison, they do they work nationwide? Do you work in just certain states? If people wanted to reach out to you and get in touch with you?
Yeah, sure. So we're the biggest national company, and we work in all 50 states. Last year alone, we did over 7,000 cost segregation studies across every asset class. So it's not something that's limited by location. It's not something that's limited by property type. People often think it's only for commercial properties. Some people think it's only for multifamily. You can do this for single family. You can do this for, like you said, retail, office, industrial, self-storage, you name it, mobile home parks, golf courses, any type of business or investment property. And another really common, I don't know who your listeners are, but a very common thing that happens is someone owns a business and the business owns a property, and they may not even think about themselves as a real estate investor per se, but let's say you're a doctor who owns their office space, and maybe you have one unit and lease out another. It doesn't matter. You can do cost segregation on that as well. Same thing if you own a company that has a manufacturing space or a warehouse or something like that. You can do cost seg as well. And so it is actually beneficial beyond what people think traditionally as just real estate investors per se.
Awesome. Now, for people who, let's say they're like, well, I call you, it's going to be confusing. Maybe my accountant doesn't understand this, right? Or I talk to my accountant, he says this, he doesn't understand, he doesn't come across this. He's not in the real estate investing world. So how do you handle a situation like that?
It's unfortunately, it's more common than you think that accountants won't be too aware of what costs, even though it's not some like weird, crazy strategy. This is directly from the tax code, and in fact is considered by the IRS the correct and proper way to depreciate your property is to break it down like this. However, what would you do in a situation like that? I would say first thing is try to educate them, show them, certain things from the tax codes, show them podcasts or, articles and things like that. And if they still are, really against this or think it's some sort of scam, which I've actually had, believe it or not, someone come to me and say their accountant said this is a scam. But if it comes to that, I would just say if you are a real estate investor, you want to make sure to have an accountant that understands real estate. As simple as that. Just like if you were, a manufacturer or a dentist, or you want to have an accountant who specializes and knows the specific deductions that can come with that specific business.
That's amazing. So, and then when you were speaking earlier, so is this a flat fee? It doesn't matter the size of the property. It's just a flat transaction fee each time. Is that how you guys typically work?
That is correct.
That's amazing. And so would you typically talk to a client prior to them closing on a property while they're in due diligence or after they close?
Very common. People will like to understand even during the due diligence, once they have something under contract, they want to know, what the potential tax benefits are gonna look like if they do a cost seg. So we can run a free, like I said, upfront analysis for anyone at that point. Again, it doesn't need to get done before you close on the property, but it's important and it's good. It's educational, at least, especially if you have investors involved and they want to know what are the potential tax benefits I'm going to be getting by investing. It's a good thing to have.
Yeah, I think that's good. I mean, you doing the front end for free. I mean, I would do that in due diligence every time, just because it gives you, a better foundation to make your decision.
Absolutely.
Yeah. And this is one of the ways real estate can change your life financially. I mean, this is one of the biggest methods in order to make the biggest difference in your life, in order to shelter you from tax burden. So people, you could, so if I have $120,000 in income tax, I'm going to be due at the end of the year. In essence, as long as we buy the right property, we could take all that and wipe it all away.
It's incredible. But again, it is a strategy. It's not going to be for everyone in every situation, but it's definitely important to have it in your toolbox and use it when it's available.
Yonah, this has been extremely educational, I think, for the both of us.
Yes, certainly.
And we sincerely appreciate you taking the time to come and join us. So if people wanted to reach out to you today, what is the best method to get in touch with you?
Well, thank you guys for having me. It's really been a pleasure as well. The best way you can go to my website, yweiss.com, or simply, follow me, connect with me on any of the social platforms. I'm very active on LinkedIn and Twitter, Instagram. Again, send me a little note. Don't just hit the follow button, because I won't know that you listened to the podcast and found me here. So shoot me a little note. You listen to the podcast, and would love to connect.
Thank you so much. Yeah, and you do some great content. I know for sure on LinkedIn, I follow you, and you provide great content for everyone on LinkedIn. So it's definitely worth a follow. Again, it's Yonah Weiss. And Yonah, thank you so much for taking the time to sit and talk with us, and, have fun in Jerusalem. Hopefully we'll come see you one day out there.
That's right. Thank you so much.
And pleasure, guys. Thank you.
Yeah.
All right.
Awesome.
Thank you.
Thank you, sir.